There are several other important terms in the stock market that you should understand to become a more informed investor. These terms will help you make better decisions and understand how the market works. Here's a list of additional key terms with simple explanations. 1. Dividends. What is a dividend? A dividend is a payment made by a company to its shareholders, usually as a share of the company's profits. Not all companies pay dividends, but many established companies do. Example: if you own 100 shares of a company that pays a dividend of 10 rupees per share, you would receive 1,000 rupees, 100 shares times 10 rupees. 2. Bull market. What is a bull market? A bull market is a market condition where the prices of stocks are rising or expected to rise. It is generally associated with periods of economic growth. Example: if the stock market is increasing for a long period, e.g., many companies' stock prices are going up, it is considered a bull market. Investors are optimistic about the economy. 3. Bear market. What is a bear market? A bear market is the opposite of a bull market. It refers to a market condition where the prices of stocks are falling or expected to fall. It usually happens during periods of economic downturn. Example: if the stock market is consistently falling and many stocks lose value, it's considered a bear market. Investors are pessimistic about the future. 4. Market capitalization, market cap. What is market cap? Market capitalization refers to the total market value of a company's outstanding shares of stock. It is calculated by multiplying the stock price by the number of shares. Example: if a company has 1 million shares and the stock price is 500 rupees, the market cap is 500 million rupees, 1 million shares x 500 rupees. 5. Volatility. What is volatility? Volatility refers to the degree of price fluctuations in a stock or market. If a stock price changes rapidly, up or down, it's considered volatile. Example: if a stock's price moves a lot in a short time, e.g., from 100 rupees to 150 rupees and back to 120 rupees in a few days, it's a volatile stock. Investors often look for volatility if they're aiming for short-term gains, but it also carries higher risks. 6. Liquidity. What is liquidity? Liquidity refers to how easily an asset, like a stock, can be bought or sold without affecting its price too much. A highly liquid stock means it's easy to buy or sell quickly. Example: blue-chip stocks like Reliance Industries have high liquidity because they are widely traded. If you want to sell these stocks, it's easy to find a buyer. 7. IPO, initial public offering. What is an IPO? An IPO is when a company offers its shares to the public for the first time, allowing investors to buy shares and become part owners of the company. Example: if a company like Zomato decides to go public and offers its shares for the first time to investors, it is called an IPO. 8. Portfolio. What is a portfolio? A portfolio is a collection of all the investments you own, including stocks, bonds, mutual funds, and other assets. Example: if you own stocks in Reliance, Tata Motors, and have mutual funds in HDFC Mutual Fund, all of these investments together form your portfolio. 9. Blue chip stocks. What are blue chip stocks? Blue chip stocks are shares in large, well-established, and financially stable companies. These companies are typically leaders in their industries and have a history of reliability. Example: companies like Tata Consultancy Services, TCS, and Infosys are considered blue chip stocks because of their strong market position and stability. 10. Stock split. What is a stock split? A stock split occurs when a company increases the number of its shares by issuing more shares to its existing shareholders. The price of each share is adjusted accordingly, but the total value of your investment remains the same. Example: if you own 10 shares of a company at 100 rupees each, and the company does a 2-for-1 stock split, you'll have 20 shares, but each share will now be worth 50 rupees. The total value of your investment remains 1,000 rupees. 10 times 100 rupees equals 20 times 50 rupees. 11th. Margin trading. What is margin trading? Margin trading allows you to borrow money from a broker to buy more stocks than you could with your own funds. It increases your potential returns but also increases the risk of losses. Example: if you have 10,000 rupees and you borrow 10,000 rupees from the broker to buy stocks, you can buy 20,000 rupees worth of stocks. If the stock goes up, you make more money, but if it goes down, you also lose more money. 12th. Earnings. Per share, EPS. What is EPS? Earnings per share, EPS, measures a company's profitability. It is calculated by dividing the company's profit by the number of outstanding shares. Example: if Company A has a net profit of 1 million rupees and has 1 million shares, its EPS would be 1 rupee per share. A higher EPS usually indicates better profitability. 13. PE ratio, price-to-earnings ratio. What is the PE ratio? The PE ratio is a measure of how much investors are willing to pay for a company's earnings. It's calculated by dividing the stock price by the earnings per share, EPS. Example: if Company A's stock is priced at 100 rupees and its EPS is 5 rupees, the PE ratio is 20, 100 rupees divided by 5 rupees. A higher PE ratio suggests that the stock might be overvalued, while a lower PE ratio suggests it might be undervalued. 14. Dividend yield. What is dividend yield? The dividend yield is the amount of income, dividend you receive as a percentage of the stock price. Example: if a stock pays a 10 rupee dividend and its current price is 200 rupees, the dividend yield is 5%. 10 rupees divided by 200 rupees times 100, 100. 15th. Circuit breakers. What are circuit breakers? Circuit breakers are automatic measures that temporarily stop trading in the stock market if prices change too quickly. This is done to prevent panic selling and control extreme market movements. Example: if the market drops by a certain percentage, e.g. 10% in a day, the exchange may halt trading for a few minutes to allow investors to cool down. Summary of key terms. 1. Dividend, share of company profits paid to shareholders. 2. Bull market, period of rising stock prices. 3. Bear market, period of falling stock prices. 4th. Market capitalization, market cap, total market value of a company's shares. 5. Volatility, degree of price fluctuations. 6. Liquidity, ease of buying, selling an asset without affecting its price. 7. IPO, company's first offering of shares to the public. 8. Portfolio, a collection of your investments. 9. Blue chip stocks, stable and established companies' stocks. 10th. Stock, split, issuing more shares, reducing the price of each. 11th. Margin trading, borrowing money to invest in more stocks. 12th. EPS, company's earnings per share. 13. PE ratio, measure of the price relative to earnings. 14. Dividend yield, income from dividends as a percentage of stock price. 15th. Circuit breakers, automatic trading halts to prevent extreme market moves. What is Nifty 50? Simple explanation. Nifty 50 is like the report card of the top 50 companies listed on the National Stock Exchange, NSE, of India. It shows how the biggest and most actively traded companies in India are performing. So, if Nifty 50 goes up, it means most of these top companies are doing well, and the market is generally positive. Example: suppose you see on the news, Nifty 50 is up by 100 points today. That means, on average, the top 50 companies, like Reliance, Infosys, TCS, HDFC Bank, etc., have gained value, and the market is likely doing well. Other important terms related to Nifty 50. 1. Sensex, similar to Nifty 50, but from the Bombay Stock Exchange, BSE. Tracks the top 30 companies. If Sensex is going up, it also means the market is performing well. 2. Nifty Bank. Tracks the performance of the top banking companies in NSE, like HDFC Bank, ICICI Bank, SBI. Useful to understand how the banking sector is doing. 3rd, Nifty IT. Shows how the top information technology, IT companies are performing, like Infosys, TCS, Wipro. Indices. Nifty 50, Nifty Bank, Nifty IT, Sensex. These are all indices. An index is like a group performance tracker for a set of companies in a particular sector or market. 5. Market capitalization. It is the total value of a company in the stock market. Nifty 50 includes companies with large market capitalization, called large cap companies. Why Nifty 50 is important? It gives a quick idea of the market mood. Investors and news channels use it as a reference to judge economy trends. Many mutual funds and ETFs, exchange-traded funds, are based on Nifty 50.